Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McLean would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McLean, thanks for joining us.
Yes, we are glad you're participating with our program today. So we're talking about financial matters, answering some calls, talking about the world of finances,
yes,
helping you make wise choices with your money,
yes,
which is in part investment, part planning,
part psychology. Part psychology. It really is. It's.
I think even my own self,
I know. I know. Because I've made some great investments over the years.
Oh, yeah. And some bad ones.
Oh, yeah. And it's just my nature. Just hang on to those bad ones. Never celebrate the wins. Just live in the losses. And they're not only one or two of them. And they're not anyway.
Well, we've had a couple companies that didn't make it.
Well, we don't talk about
one
those.
that we put quite a bit of money into. It's funny because someone says, Scott, man, it seems like everything you do turns to gold. You just have the Midas touch, don't you? I'm like, no.
Oh, yeah, we did a couple.
Oh, wait, Pat, we had leased a bunch of space and had cubicles all set up. We were taking over the world.
It started well. Ended poorly.
That didn't work. That's how life goes sometimes.
I did six companies. 3 of them I talk about.
That's right.
Other than when I say companies, ongoing concerns, other than because you sometimes form a corporation around real estate. But But I got to tell you, Scott, the mere fact that we could, where you came from, where I came from, at the age of 62, I can look back at this and say, holy smokes, I love capitalism. It allowed someone without much means to grow. And then I was reading an article a couple days ago about China and how their EV, they have an electrical vehicle problem that they actually don't know how to handle.
What's their problem?
They're producing so many electric vehicles in these government-sponsored companies that compete against each other that they're driving the prices down so low that everyone's losing money. But
government controlled.
Because the fact that it would cause great unemployment to lay these people off, they get in these spirals. The same thing they did with the real estate thing.
The housing.
The housing, right? It's just like
I don't know where the housing is, right? Because that was in the news every other day for a long time, and I don't read much about it anymore.
Oh, yeah.
I still see photos of cities that are completely empty.
Well, because most of the companies have actually, the 3 biggest ones have closed down completely, and they're writing them off.
And then suddenly the CEOs disappear too. That's right. That happens in China too.
It's weird.
Yeah. Your business doesn't go well and suddenly you're in
say something wrong. But so I was thinking about this. I read this article, and then I love YouTube because you could go on and just any subject you want to watch a little video on, you can. And then you got to look
anything.
at this. I watched a movie on how to grow pineapples and how do you grow pineapples, and then how do they pick them and how do they put them in cans.
That sounds fascinating.
It was fascinating. But so I was thinking about this, and then the very next day, I read in the Wall Street Journal.
Thinking about the pineapples or thinking about the EVs?
EVs. Sorry, I'm jumping around here. And I see Elliott Management takes a stake in PepsiCo. And I see they take a stake in PepsiCo, and I think, I love capitalism. I love and this is an activist investor, and I think this is beautiful.
You love following the activist investors?
Yes, because what it does is stops these things like that happen in China, where these organizations get away from themselves and forget that they're serving a shareholder, right? And that, you know, it's happened with the DEI, all these things where all of a sudden they're like, stop, doing? Just stop. Just stop.
Well, for a while,
to-
remember, Pat, it was not many years ago, they were talking about it's all these different stakeholders. It's not just the shareholders. You have to, all these other things. And part of it, like,
that's true to a point.
It's true to a point, but if you're not delivering on the shareholders, that capital is going to go to your competitor who does deliver it for the shareholders.
That's why, to a point. Once you deliver to the shareholder, then you could spend time on, obviously around the rules. You can't exploit the environment or people or whatever the word exploit means, which is always the problem. But then I thought to myself, what a contrast. I mean, this is why we bet on the U.S. stock market. Right? This is why you bet on the U.S. Why you bet on broad baskets of stocks and not individual ones is because of exactly things like this, which is, look, PepsiCo, if you look at its performance and then what Coca-Cola did to itself 7 or 8 years ago when they re-engaged their franchisees and actually changed their business model, Elliott Investment puts $5 billion.
Is Pepsi not done well? I pay no attention.
It has not done well. And it's a huge conglomerate. I mean, it's massive.
They own all kinds of...
Yum Brands spun off of PepsiCo. Yeah. In fact, when I was in college, I thought I wanted to go to work at PepsiCo. Just because...
Really?
Yeah, because I just thought they were so brilliant.
All the corn syrup they can deliver right to the marketplace.
Look, they're selling sugary drinks for lots of money. And then Frito-Lay, and then at the time it was Kentucky Fried Chicken and
all the healthy foods,
all that stuff. So, but I thought this is why you bet on a capitalistic system and why over time it actually does well over time.
Well, the free markets, it's a beautiful thing. Either you are adding value or you're not.
And who decides what value add?
The consumer.
And without the government telling them what to make.
When the government starts telling them what to make, that's when we have a problem.
Which is what we talked about
My belief. That's why you look at what's happening in New York on the election and people thinking, well, rent freezes, like how does that work? Look, I've got a colleague, he says he just got rid of their last rental house in California, been in real estate forever. He says he was never going to own another rental in California the rest of his life. None, not one. Because of the amount of regulations, the how hard it is to evict someone. He had someone in there for months and months and months without paying the rent, had all kinds of false claims, claimed there was mold, claimed there's rat infestation, everything you can imagine. And there's attorneys that'll take these cases on, buried them in legal done.
That's your point, right? Capitalism. In government regulations, right? So the person, it doesn't mean they're not going to own a rental. They're just not going to own a rental in California.
Correct. That's exactly right.
Right?
You're going to do somewhere where you can go build a house without,
Yeah. But this is why, so when you invest in the stock market, right? And the reason we're talking about this now is we used to do these things with our clients years ago called the lifeboat drills, which we would actually bring them through false scenarios.
We still do that.
Oh, we do.
Yeah. Stress test the portfolio, and here's what it would look like during these various times,
and not percentages. Show them dollar amounts.
Right, because if you have 10,000 saved, you lose 10%. It's $1,000.
Yes.
You have 10 million saved, you lose 10%. Suddenly, it's $1 million. You're thinking, "Holy crud! I know how hard it was for me to make that money."
Yeah, and immediately you convert that $1 million to what you made on an annual basis, and you think about the years of labor. That's how the mind thinks. Most minds think that way. And so, but in reading, just in over a 2-day period, I was thinking about this China and just this terrible system they have on allocating capital. And then the very next day, reading this article about Elliott Capital Management taking a stake in PepsiCo and the management.
The difference between government coming in and trying to solve the problem, the other is free markets.
It's free markets. And the people at Pepsi are just not happy about
this.
And
when they talk about these sort of investors with like Elliott, they raise capital from other outside investors. They say, look, our job is to find underperforming companies, buy a big enough stake so we have a seat at the board, shake things up, get them to be running well again, and then we'll exit our position.
Right.
And then we return money to our investors.
Yeah. And sometimes they get a bad rap because they shake things up, and I think this is brilliant. I love this. Which is why you should be an investor in the U.S. stock market over the long term. Because the market finds itself a way around. And who is the market? It's collectively all of us, but the smart strategies emerge.
And it's hard to know what tomorrow's winner is. How do you know?
That's why. Well, you keep reading. Like I read an article this week about the price to earnings ratio on the S&P 500 being the highest it's been since. But then it's talked about how it's being driven by just a few companies. Well, and that's dangerous. But I thought, well, the counter to that is
worse, right?
The counter to that is that there's a lot of the companies that are up and coming that haven't been able to produce, that haven't caught on in the marketplace, which is a great counterbalance. If the
top performing companies, how many were even existed 20 years ago?
Not many of them, or they were unknown. Yeah, no. They weren't. Kmart wasn't the top producing, and Sears Roebuck wasn't the top producing.
Apollo Lepesco, who we've had on this program before, he's great. He described the stock market. He says, "Well, it's a place where you can own a company that you didn't start. You can own a piece of a company that you didn't found, and that's a good way to look at it because it's like a casino. No, it's really not. And it's like the older I get, the more I'm like." I really do love equities.
I do.
Because
you can make an argument why 100% of your portfolio should be in equities. I could make an argument against it too, but
I remember meeting a guy at a conference. He had sold his business. He invested 100% of it in the Vanguard S&P 500 fund.
That's a little.
He said, I don't know if it was good or bad, but I know it works fine for me. And I thought, it's going to work out just fine for you long term. From a tax standpoint, it's really efficient. Most of it's capital gains. Step up base when you pass,
it
qualified dividends at a lower tax rate.
It probably produces enough
income. That's right. I'm like, how do you argue with that?
It works anyway.
Yeah. Well,
thank you for listening to my rant because and then I think about we should have Apollo Lepesco on again. He's my. We don't have a ton of guests, but he is. Because when I was thinking like that, I was thinking this is what's his name said. Apollo said this. About the markets. And it's not everything you invest in is going to be a winner.
No. Years ago, Pat, I used to own this, this was 30 years ago, this mutual fund, some global mutual fund. And I kept it longer than I needed to, in part because I liked their annual report. I realized I could have got their annual report, but anyway, it kind of kept me a little more motivated to be involved. But their annual report, they would list their top 10 performers, right? This one up 800%, this one's up 700%. Then they would list their bottom 10.
Good for them.
Bankrupt, right? And I liked it because I thought, this mutual fund company has a team of analysts. They go in, do this research. They fly all over the globe, visit the management team. They make investing decisions that led them to the top 10 performers well as all the ones that went bankrupt. The same people. Which is the danger of trying to pick individual companies, which is, I think, why most financial advisors like us talk about the importance of being highly diversified. So, all right. Anyway, let's take some calls here. If you want to join us, questions@moneymatters.com will get you on. Let's talk with Jeremy. Jeremy, you're with Allworth's Money Matters.
Well, hello, gentlemen.
Hi, Jeremy.
First, I want to say thank you for taking my call. But more than that, I just want to say that I stumbled on your guys' show back in late 1995, I believe. I must have found you very near the beginning.
Because we started in middle of 95.
Okay, and that's when I started my first what I would call actual job. And I started listening to you guys, and I'd made it a priority that I would go home on Saturday afternoons at noon, I believe it was, and I would wait for you guys' show to come on and listen to it. I think it was 2 hours back then.
Yep.
And I learned a lot with you guys over the years, and I really got fascinated with the idea of compound growth. And that's how much I made at the time. It was $5.35 an hour. And I started by saving $20 a week at the time.
Wow.
And over the years, we've gotten raises and promotions. I've upped that savings, and I put a lot of it, onto what I've learned from you guys. And I know I've listened to you guys long enough that you'll say, I did the hard work. That I did the hard work.
You did do the hard work,
you guys. but it was a lot of the things you said that kept me grounded. Things about the markets going up and down and staying invested, leaving it where it was, and not monkeying with the money and changing investments around too much. And just a lot of good advice over the years kept me interested, kept me reading books and learning more and more about finances. And I really want to thank you guys for that. You have a partnership in this, I promise.
Well, thank you. That made my day. But you were the
it
disciplined
more than made
one.
my day. There were many of weekends where there was a tremendous sacrifice to come in and do the show, and missing kids' sporting events and a variety of things. And I mean, when we used to broadcast live on the weekends, and I suppose I could look back and at this stage of my life say this has been my life work. But and money is just a piece of life, but it's really hard to have a lot of peace in your life when you don't have financial peace at home. And by having some financial independence, it gives you tremendous flexibility in where to use your gifts and talents in life. So.
And you should be proud of your discipline too. It's you were disciplined.
I'm trying to convince myself as we go along that at some point I have to transition from that saver into someone who's willing to spend it. That's going to be a difficult transition from me, but I hear you guys talk about it, and I know that that's something that I need to work on.
Well, those are good problems to have.
Yeah, and that's true. I try not to complain, but as you said, the piece of it, and the other thing you guys say about being able to choose what you do, when you do, and how you do it. That's a neat piece of advice. But I always thought the financial security, it just brought me peace at home, because I remember a time not having very much money where just little things might cause a rift between me and my wife, which I wouldn't want. But it could, just something going wrong, with the refrigerator breaking or something. It brings a level of stress into a home, I think.
Yeah.
That once you have some security behind you, really, it allows you to live just a little more peacefully, I think. And
Jeremy,
that's what my goal is.
That I to this day I can remember having almost no money, weed eating the backyard, hitting a rock, the rock flying into a sliding glass window and breaking it, and me thinking, what the heck? Just like
you have no money for the for the sliding glass door.
I have no money, right? And you're just like, oh well, I've got to replace the sliding glass door, right? And you think about that now, and you think back at, and you're like, well, that's part of it, right? That's just part of life. Anyway, what's your question for us?
So last week you were speaking to a gentleman, and I thought I'd heard all the questions, and he was talking about an after-tax contribution to his 401k, and this is something I just started looking into a couple of weeks ago. And you had asked him the question if he had an IRA outside, and I'm assuming that would have to do with the taxation, where they call it the pro rata. I don't understand it completely.
That's correct.
But he had said no, so you guys didn't continue down that path. But I do.
Okay.
So I'm wondering if that's going to affect what I'm trying to accomplish. Now, what I'm going to do, according to the way my company's plan works, is they will do an in-plan conversion on the day that it enters. So they say there won't really be any tax consequences, but that I can, as soon as it goes in after tax, that day it will convert to a Roth. I didn't know maybe if that would. That's what Fidelity said. I called them and they set it up for me, and they said it would be, immediate.
So let me understand. So this is for contributions in excess of the limits. Is that right?
Correct.
And they're saying that you can make an after-tax contribution and they will immediately convert it to a Roth 401k, you don't have to convert it to a Roth IRA.
Correct.
Wow.
I've not seen that.
I have. That's new to me.
Oh, I mean, that's the way they explained it to me. And, they never asked me where to send them, where to send the money outside. But I mean,
because what typically happens, first of all, a lot of companies don't allow for excess contributions on a lot of 401ks don't allow for after-tax contributions. And so once you max out either pre-tax or a Roth contributions to your 401k, you're maxed out. Some companies allow you to continue to make contributions on an after-tax basis. And when you do that, let's say you put in $10,000, any growth, if you leave it that way, any growth is going to go into the tax deferred portion. So let's say that 10 grand ends up making 5 grand over the next several years. That 5,000 is going to be part of the tax deferred portion of your retirement account. So at retirement time, when you say you transfer it all out, that 5,000 of earnings is going to stick. It's going to go into a regular IRA, while the 10,000 after tax conversion can go to a Roth. If you can immediately convert it to a Roth,
and there's nothing,
then that $5,000 growth is going to be in the Roth portion.
Well, and it makes,
or that's why oftentimes it's encouraged to people to, on an annual basis, to do an in-service. This is how it's been historically, and it hasn't been happening that many years where you can do these things. Historically, it's been you put the money in after taxes. At the end of the year, you do an in-service distribution, and you convert it to a Roth IRA. So that way that future growth stays in the Roth as opposed to the...
And that's when the pro rata comes into place.
With other IRAs, but
With
it's
other
not the case
IRAs,
with the
but
401.
it doesn't... It makes sense to me. And it makes sense. I don't... We'd have to look at the tax law, but if the plan allows for it, it makes absolute sense.
So if there's no earnings growth, then it probably shouldn't cause any issues for my outside pre-tax IRA?
That's correct. Okay.
I'm still suspect.
I would do a little bit more research before I said, but what you just explained is correct. It's no different than when I make an after-tax contribution to an IRA. Wait 1 second.
Right.
So I make an after-tax contribution to an IRA. I convert to a Roth IRA the very next day. It makes perfect sense.
But you can't call up your employer and say, "Hey, I've got $100,000 in my 401k. I'd like to take $10,000 and convert it to the Roth 401k." I've never heard of that. Because by doing that, this is essentially the same thing. It skirts the rules of having to say what is your tax basis in your IRAs and taking that into consideration where the pro rata accounting comes into play.
How many people did you talk to at Fidelity that answered the question?
Just one. Now my HR department here that I work for told me I needed to call them to set it up because I need to call them to set up the automatic conversions. And so when I called in, I told him what I was trying to accomplish, and he said they sent me over to the person who handles our company, I guess. And he said, yeah, and I asked him directly, is this going to cause any taxes, like any growth taxes inside this plan that I was more concerned with, I'm going to end up with another, tax filing problem more than anything. And he said, no, it happens immediately, and there won't be any taxes because there won't be any growth.
Wow. Well, listen, you've been listening to the show for a long time.
We actually have a retirement plan division at Allworth with
we could ask them.
Many companies that have retirement plans with us, and I will actually make sure I follow. But my guess is this has been a change that that has slipped us.
And maybe if I can add on and just ask, is Roth maybe? Am I getting too heavy into this Roth thing?
Nope.
Because I really don't know that I'm going to be in California forever, and I feel like I'm paying this big tax up front.
Well, on the we've been discussing after tax contributions. So you don't have the ability to take a tax deduction because you've already maxed out your 401k. So on your 401
on a pre-tax basis. Have you maxed out
my 401k is almost all Roth as well.
Well, that's a different question altogether. So that's
Correct.
a completely different question.
Yeah,
now I've got it 50-50. So basically almost to the dollar, I have 50% of our retirement in pre-tax and 50% in Roth.
And what are those balances?
It's right around $600,000 each.
And you said you're in your 50s?
49.
I'll be 50 in 2 months.
And what's your family income?
Oh, probably, give or take 250. But we're in the midst of, we're cash flowing a daughter in college who will graduate later this year. And then we have a 2-year break, which is why I was going to go to after tax, because we have a 2-year break before our second daughter goes off to college. And so we'll have some excess money. And what I'm trying to get done here is I'd like to have basically my retirement done by like 55. Not that I want to stop working, but I would like us to be able to do more.
And you think you think you'll leave California?
I mean, it's actually our dream to leave the United States, and nothing against the United States or California. They've been very good to me, but I feel like we would like to we want to try another culture.
Like move to Spain or
what's that?
Spain, Costa Rica, Ecuador.
Costa Rica's our dream. We're going there for our third time next week, as a matter of fact. And when we went down there, I think we kind of like to start a business of running some rental units and rental properties down there.
Then I would make it all pre-tax contributions, 100%.
To California, maybe more than that.
But the other thing that I listen to you guys a lot on, and that's leaned me toward Roth a little bit, is that someday they're going to probably strongly means test on the Social Security. And I thought, if they do that, they may start with just your taxable income. And so, if you can keep your taxable income low by using Roth, you might get more of your Social Security dollars.
Yeah, but let's say you're $600,000. Let's say you don't contribute it. Well, even if you contribute it for the next several years, let's even say that's $2 million, which would be a long time from now. Required minimum distribution is about $80,000 a year. That might be your only taxable income.
Yeah, you absolutely want to go pre-tax.
Okay.
Absolutely.
Okay.
I would.
We put 100% of my wife's in pre-tax, and usually what I do is I do just enough. I do enough pre-tax to keep us below the threshold so that we can still do Roth in an IRA for each of us.
I would still go pre-tax based on the premise that you're going to leave the state of California.
Okay.
And I got a question.
Are you doing IRAs or Roth IRAs?
I'm sorry?
I said Roth IRAs.
Okay, yeah.
Yes.
Yeah. Yeah, so still pre-tax.
And you have you have a question.
Oh, I had a comment about Costa Rica. So
yes, sir.
My family and I went to, it's a small world, right? It is a very, very small world. My family and I went to Costa Rica.
It's a small world if you have money to buy plane tickets to fly your family to Costa Rica. I don't think you flew to Costa Rica as a kid growing up in the McLean household.
We went camping.
Okay. With a 2-hour drive. Right?
We did.
Okay. Same thing with how I grew up.
Okay.
No Costa Rica for the Hanson family, Hanson kids when I was growing up.
Oh, this is really now going to sound like a rich person
Yes, it does.
story.
Yes, but yes.
Okay, we were on a private yacht off the coast of Costa Rica.
Oh, you were not.
We were not. We were in Costa Rica, and we were on this trip with the 4 kids, and we had.
By the way, Costa Rica, you can do very inexpensive.
Oh, it's very, very inexpensive. It's very
much less expensive than Hawaii.
Yes, yeah.
It's probably less expensive than Cabo.
It's beautiful. So we get in this van and we go to this resort in the middle of like nowhere, and it's up this dirt road and it's muddy, and we get there and we get to the resort and there's almost no one. It's a beautiful resort. There's almost no one at the resort. And it's not that expensive, a couple $100 a day per room, and it's beautiful, and we're at the beach, and at the end of the day, my wife, we're in the swimming pool, and we swim up to the swim-up bar because we can. We can swim, and
there's a bar in the pool.
And there's a bar in the pool. And we're standing there, and we're having a drink, and the guy next to me goes, "Hey, Pat, how's it going?" And I'm like, "What?" He goes, "Oh, I go from the gym." And I'm thinking, but now you ruined my story by making it a rich person story.
I was in San Francisco a couple weeks ago, and the gym that I went to when I was there had a executive, not the lounge, the men's locker room. There's the executive portion.
Oh,
so I had never.
Oh no, the gym I go to.
You have the executive gym.
No, but what I really liked about the guy is he actually had. In order to save money, he rented a VRBO right next to the resort and then would sneak in every day. Anyway, well, Jeremy, thank you for indulging me in my little story.
And thinking, you taught us something today.
Yes, thank you. Appreciate your time. And
thank you guys for your part in where I am today. I really, really do appreciate it. I'm sure there's a ton of people out there that you'll never talk to who you've made that difference in their lives as well.
Wow.
So appreciate that, I hope.
Well, thank you,
Jeremy. I'm gonna play this little clip of recording when I wake up in a bad mood and feel sorry for myself about something.
I'm going to play it for my family on
I'll feel
Christmas.
the grave injustices in my life.
Christmas morning, I'm playing it for my family.
Enjoy. Before you get the stockings, kids. Do you guys still do stockings? Does your wife do stockings for the kids?
Yes, she does.
Yeah. Do you get stocking stuff?
I don't.
Is there a Pat stocking?
There's one on the fireplace. Is there stuff in it? I don't remember.
Good thing your wife doesn't listen, because she probably takes those.
I don't think so. I don't think there's anything in mine.
Yeah. Anyway,
Obviously, I haven't paid enough attention, or I would remember.
Yeah. We're talking now with John. John, you're with Allworth's Money Matters.
Hello there. Thanks
John.
for taking my call. A two-part question on charitable giving accounts. I believe I understand that you can distribute money from those accounts over several years over to several different entities, charitable entities, but I'm not clear on, must you take the full amount of your contribution to that account in one tax year, in the same year that you...
No. So
let's clarify. How old are you?
70.
And you're speaking of a donor advised fund.
Yeah.
Okay. So, and a lot of the big institutions have I think Fidelity was one of the first ones to come out. Fidelity's got a big one. Schwab's got a big one. There's several of them out there. The wonderful thing about a donor advised fund is it's almost like a private foundation, a family foundation, without all the headaches
And visibility.
Yeah, and it's private, because if you have a family foundation, others can see what's in there. They know what you're giving to, and you can get hounded nonstop. And the nice thing about these, John, is you can contribute whenever you feel like it. So if you open up an account at one of the major firms that has a donor advised fund, or there's other foundations that just have donor advised funds.
Community foundations. Lots of community foundations.
Don't leave anyone out here. So you can transfer appreciated securities there if you'd like. You could some of them allow you to transfer an appreciated piece of real estate to them. You can write them a check, and you can contribute as often as you'd like. And every time you can contribute, it triggers a potential tax deduction for you. So it creates a taxable deduction for you.
And once it's in that account, it can sit there forever.
There's no minimum requirements.
So, I mean, I've named beneficiaries on mine so that if my wife and I pass away, that our children can distribute them. Not that there's tons of money in there, but and what is a good idea is for tax planning to decide how to bunch them. So many people will say, I'm not giving, I give to the charities every year, but I'm only giving to my donor advised fund every 3 years or 4 years.
Because the standard deduction is so high now, and particularly if my guess is age 70, you don't have a mortgage, don't have a tax deduction on the interest any longer. Oftentimes people make, even quite generous people that make significant gifts throughout the year or at the end of the year, aren't able to take an itemized deduction. So a donor advised funds enables somebody to accelerate that.
And you can...
Okay, but I guess the bottom line, though, is I don't quite understand. Am I forced to take the full amount of whatever I donated, or not donated, but whatever I contributed to the fund? Am I forced to take that full amount in one tax year?
Yes. Yes.
Well, no, because there's limitations, and if you exceed the limitations.
But in most circumstances, for the average American, if you put money in the donor advised fund, you take the deduction in the year, and that's gone. I mean, you have given that money away. You get the deduction. The only difference is now you get to direct it to what charities you want over as many years as you want. And I've got to tell you, once you've done this, you will not give to charities in any other way. You just won't.
Rarely you might. It's the school, your neighbor's kid is $100 donation.
Yeah, you're buying. Right? Okay, yes. And so, as an example, every one of my clients that I have introduced to this, they're like, "This is fabulous," because you just go online, you type in the tax ID number, it actually pulls up the name of the charity. It takes about 2 minutes, and they issue a check, and and you can manage the money inside there. You can keep equities, you can keep it in cash. You can actually hire a financial advisor and pay them to manage inside many of these donor advised funds.
Okay, so let me clarify. Let me just reiterate.
Okay.
Make sure I understand. So if I want to donate an appreciated mutual fund,
Yep.
Perfect.
There is a limitation on how much I can claim as a deduction in 1 year,
Yes,
and then the rest of it carries forward to the future. And the last part of this question is this fund that I want to donate. I purchased in the early 90s, and it has changed administrations, companies a couple times, and they say they can only give me a cost basis.
You don't need a cost basis. You get to take a deduction of the fair market value.
Perfect. This is the perfect security to use.
Okay, great.
It is the perfect security. Because you'll probably never find the cost basis.
That's right.
The reality is,
and if you sold it, you just make some guess,
and then you guess, and then at the IRS
make a realistic guess.
So this is the perfect security. You get the deduction. You don't have to worry about the cost basis. You put it in there. If you want to continue to own that security, just replicate it in your portfolio.
You could. Maybe it might not be the best thing.
But if you want
you probably wouldn't buy it today, whatever it is you own.
But if you want to continue to own that security, you can buy it back and you reset your cost basis on it.
Okay.
It's perfect.
Full market value is what I'll get.
That's correct.
The deduction.
Thanks, John. As far as beneficiaries, like I've got ours set up where I think it's about 90% go to pre-designated beneficiaries that I have structured over a period of years. And then like 10% goes to where my kids can direct it or something along those lines. I forget exactly.
Yeah, you can put rules.
And you can change it.
Yeah, and you can change the allocation in it. It's really slick. It's really, and the visibility, visibility is something. So it sits in this fund.
And look, this isn't just for people with tons of money.
Oh no, I do it for people that give away $5,000 a year.
That's right.
And I do it for two reasons. One, it just makes giving that much easier. And two,
it's tax efficient. The government,
super
if you do it right,
efficient.
it's like the government gives you a match.
That's right. It's super tax efficient.
Yeah. And I don't know if I've talked to many people who've regretted giving money to the right charities.
Well, that's the key. The right charity.
I did say that. Yeah. Well, I was on a board of a community foundation for a few years, and I said in one of the board meetings, I said, I think half of these nonprofits should be killed.
Okay.
Didn't go over too well. No. But my point was, there's a lot of people with big hearts, right? And they're maybe not skilled in I have a heart for foster youth. My wife and I adopted 2 foster. I have a heart for foster youth. But for me to suddenly, if I went and started this foster organization of some sort, my guess is I wouldn't do as good a job as someone who had spent their career understanding these issues and so there's lots of great organizations, and lots of organizations where there's great heart, but not very effective
execution.
But there's some phenomenal organizations out there as well.
Yes.
Enough about that. And we're now in Washington talking with Shar. Shar, welcome to All Risks Money Matters.
So I have a question. It's about stocks. My husband and I, we have about $600,000 in 401k pre-tax savings. We have 30% in cash, 50% in index funds, about 10% in bond index, and then 10% in various stocks. Also, we buy stocks, and if it's a win, we sell it and take a quick win. And if it's a loss, we keep it forever and ever. So I was wondering
just to remind you of the poor decision, or what? Why do you keep it forever?
Let's just say it's not my choice.
Got it. Okay.
We are close to retirement, and I think me and my husband, we have to merge our risk levels. I think he thinks that we're going to get a win, so we keep it, that it'll turn around. And it's occurred to me the other day, that means I think we have too much in cash. We're not making money. And that if we sell when we make money and keep the losers, then we have short-term wins and long-term losses, which means we're going to lose a lot more, right?
And well, how much money are we talking about in the
600,000?
No, that's in the IRA, and the brokerage account is where you're. Where the money that you're buying the money that you're buying these stocks in, are you doing it inside the IRA?
Yes, I have one at Fidelity that's active with my employment, and then another one at E-Trade. It's pre-tax.
Okay, and none of it. So this, when you're buying these and selling these stocks, none of it's in a regular brokerage account. It's all in an IRA or a 401k. Is that correct?
Almost true.
Okay.
We have about 75,000 in a Fidelity, and that one's not pre-tax. And
Okay.
that one's in, I think I got VFIA.
All right, you're not trading that one.
You're
then.
not trading that one. Okay.
You're not triggering taxes for yourself. So, I mean, let's start with the first thing, cash. You mentioned too much in cash. I think cash is fantastic to put money that you're going to need within a short period of time.
What is a short period of time, Scott?
If I plan on buying, let's say you plan on buying a vacation home next year, or you're a couple years off from retirement, you plan on moving somewhere and you want to have some flexibility to buy something before you sell your existing, or whatever it might be, you're going to take one big trip around I don't care what it is. If it's money that you need within 5 years, cash is fantastic.
That
it
is
doesn't
appropriate.
fluctuate in value. You know it's there. When you call up the bank to say time to transfer the funds, you know what the value is going to be. Great for short term. Terrible for long term investments because it just doesn't earn that much. And if you consider stocks historically, if you go back the last 100 years, they've done about 6 to 7 percentage points above that of the rate of inflation. So let's say inflation's 3%, they've averaged 10%. That's historically, that's the kind of return you get, as opposed to cash has usually been about 0.5 percentage point above inflation. So particularly in 401k investments, having a large allocation to cash, I mean, unless you're planning on yanking those dollars out and spending them, it just doesn't make a lot of sense.
It makes no sense.
It makes you feel good because your portfolio doesn't swing as much, but
Yeah, but it doesn't. It isn't based on really what your timelines are.
nor what your retirement needs and objectives are.
Right. It's just kind of, well, it's worse than stagnating, right? Well, I think his thought is if he has cash and he sees a big deal, he can buy it.
Okay.
Well, so let's talk about the individual stocks for a moment.
Okay.
So you own index funds, right? In your portfolio.
Yeah,
you
we
mentioned.
have a lot of index funds.
And the reason index funds have become popular, one, they're low cost, but two, even more so, it's most professional managers can't outperform the market.
Especially the
Even
broad
with
market.
their teams of analysts doing all that research, the vast majority do worse than if they just said, you know what, let's just forget all this. Let's just buy the index. So on the one hand, you believe that. That's why you own index funds. But for some reason, your husband thinks he's got some skill that surpasses Wall Street to be able to trade stocks. Now, people invest for a lot of different reasons. Some of it is a bit of a sport, a bit of gamble, a bit of all those things. And I think it's fine if it's kept to a small percentage of one's portfolio. And for example, if you and so obviously you and your husband don't see eye to eye on this. My guess is there's other parts of your marriage you don't always see eye to eye. There's parts of my marriage we don't always see eye to eye. But we have a conversation. We say, look, how do we make this work for both of us, even though we don't fully agree? So maybe the right thing is that 10% never goes more than 10%. He can trade how he wants. Maybe it's 5%. I don't know. But
I would have a tendency to actually segregate those dollars into the brokerage account, leave the 401k money as
carve it out at 10% special IRA.
a special IRA that allow him to trade in it. And by the way, the idea that you never sell any losers, the thesis is just foul. It makes no sense at all, because the question you should be asking.
And you'll sell any of the tomorrow's leaders if you sell the.
Yeah, but the question you should be asking: would I buy this stock today if it was available to me? And if you say, yes, I would buy this stock today if it was available to me, then you continue to hold it. And you do that with both your winners and your losers, not sell your winners and keep your losers. But that's a completely different, he'll need to call us directly to get that sort of input.
That sounds like great advice. Thank you.
All right, Shar.
I do have a few other questions. I don't
Fire
know
away.
if you have time.
Yep.
Sure.
Oh, okay. So I'm a
So
Boeing
one of the,
employee.
so we for years we were on the radio, live on the radio, where we had to live by the radio clock, right? So whenever the commercials were coming, the breaks, we had to get through the calls quickly to get the break. We've moved past that. We're still broadcast on terrestrial radio, but we designed this program now more as a podcast, and we schedule our calls, so it gives us time to have a little more in-depth conversations, which we enjoy. So fire away at your next question. And you wouldn't have, by the way, they wouldn't have, our screener wouldn't have scheduled you if they thought you were a bad call. So,
Okay. So I'm a Boeing employee, and I have a pension. I'm lucky because the trend is to not do pension.
yep.
But I do have a pension, and we're not sure, my spouse and I, what options. We have a lot of options to take. And the big one is, just take a lump sum. He looked, you can put it into a pre-tax.
Yeah, you can roll it into an IRA. And what's the size of that
Or-
lump sum?
It should be around $300,000.
Okay, so $300,000.
Or we can take, a monthly chunk.
And so the number we'd like to compare to is the full joint and survivor. So in order to compare apples to apples, you take the pension lump sum and you compare what would happen if you took a pension and if you were to predecease your husband, he would receive exactly the same pension. And so the Boeing pension probably has 7 or 8 different options that you can choose from.
Yeah.
The one we're interested in is the one that actually is the same level, whether you're living or dead, that goes to your husband. What is that number?
Yeah. 1 second. Let
Okay.
me get that because I have it right here.
Okay.
Pension. Yep. It's 100% survivor.
That's right.
Okay. Yeah. And so that is around, let's see, if I retire when I want, it's about $1,800.
Okay, and how old will you be when you retire?
65.
Okay.
So a couple things on this.
How old are you now?
62, and he
Okay.
is 65 now.
Well, I'll so does he work at Boeing as well?
No.
Okay, so we're going to give you an answer today, but it's not going to be the right answer for 3 years from now. And the reason is that pension lump sum moves up and down based upon interest rates and your life expectancy. Essentially what happens is the pension sets aside a lump sum of monies for you, and they use this internal interest rate in order to determine that lump sum of money. And then the idea being is that if it's 7%, the internal interest rate, that based on a normal life expectancy, that pot of money should be empty at the remainder of your expected life.
Knowing that some people are going to die prematurely and some are going to live much longer.
And so what happens is the lower that interest rate, the higher the lump sum. The higher that interest rate, the lower the lump sum. But you need to do the calculation at that particular date and time.
And then there's a couple ways to look at it. One is to say, what rate of return do I need to earn to provide that same income while maintaining my principal?
And
That's how most people like to look at it.
And we'll refer to that as the hurdle rate.
The other one is to say, well, apples to apples, what rate of return would I need to provide that income to the remainder of my normal life expectancy and then have it go to zero by that point? So it's a lower rate of return you'd need to.
So the things that you take into
But most
common,
people don't like seeing their account balance going down.
That's right. So you want to calculate it based on what you
Hurdle
would hurdle rate, or what you would expect that you would return in a well-balanced portfolio.
The older you are, the harder it is to justify a lump sum. Just because it's not that big, right? I mean, if you're retiring at age 80, your life expectancy might be 6 years. It's not going to be very, very much money.
So the answer to your question is call us back in 3 years. And by the way,
We have we have probably thousands of clients that have taken lump sum.
so if you were calling today and saying, I'm leaving today, assuming everything else is equal, that you have a normal life expectancy, and that comes into play, your husband has a normal life expectancy, we would tell you today we'd be more inclined to take the pension, and I would increase the allocation in that 401k up to 75% equities.
Oh, you would take pension lump sum, not pension.
No, I'd take the monthly pension. I'd take the monthly pension if it was today, and I'd increase the 401k allocation more to equities. That's as little as we know about you now. Now, if you have millions of dollars elsewhere, that might change our opinion because you're able to tolerate a little bit more risk in the up and down.
Okay.
But you're not going to get an answer. You're not. In fact, you could worry about it if you want, but you're not going to get an answer until you're ready to retire. And I would plan on taking the pension. And if interest rates are really low at the time you go to retire, maybe you'll take the lump sum.
Well, we are getting near our end of time, Pat. I want to let our listeners know here, we've got a great webinar. I say we, because I hosted it.
Are you on it?
But Victoria Bugner was our head of wealth management, head of wealth planning. She is the star of the show.
She's bright.
Well, I like to think I'm somewhat bright. But anyway,
Well,
this...
okay, you. I don't think you're as smart as she is.
I'm not. Are you kidding? Whatever. I'm not going to mention that.
Okay.
Anyway, I think you're correct. On an IQ, well, there's no question.
Oh, there's no question.
No, there's no question.
Much smarter. She's so much smarter than you.
And she knows the technical stuff better than I do. But this webinar is Wealth Strategies for the Modern Investor, and it's really designed for those with $5 million or more of investable assets. And some of the things we're talking about is limiting downside risk by using buffered ETFs. We're going to talk about private markets and how that might enhance your diversification. We'll talk about using option overlays to help with your returns and also navigating the new tax laws with truly coordinated, some forward-thinking tactics. So all those things, Wednesday, September 17th at 10 a.m., Thursday, September 18th at noon, Saturday, September 20th at 9 a.m. All those times are Pacific. To learn more and to register, go to allworthfinancial.com/workshops. It's been great having you with us. This has been Scott Hansen, Pat McLean, Allworth Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.